All right, so welcome everyone. Welcome to another installment of the webinar series, Law and Political Economy and Heterodox Economics. The objective of this series is to establish an ongoing exchange, a dialogue between legal scholars and political economists, focusing on the legal economic nexus. We have already hosted Jamie Mudut, and we have scheduled webinars with Daniela Gabor and Ingrid Kvankhaven in the coming months. But today we are delighted to have with us Dr. Jens van Klooster from the University of Amsterdam. Jens is a political economist with a background in philosophy, and his current research covers areas that are of particular interest to law and political economy scholarship, such as central banks with a focus on the ECB and its monetary policy, EU economic governance, and the issue of technocratic legitimacy, and climate finance and monetary policies in favor of the green transition, which is also, may I say, a thematic area of our more, let's say, stricto sensu funded project of law and political economy in Europe, that of green transition, I mean. So these are all, these are the core topics that we'll be discussing today, drawing from Jens' work. And I'm very much looking forward to an engaging and informal discussion. We're also grateful to have with us a great group of legal scholars that have been, let's say, engaging with law and political economy in Europe in different setups. So we are delighted to have with us Professor Marco Goldoni, who's a professor of philosophy of law at the University of Glasgow. Dr. Agnieszka Smolenska, who's an assistant professor at the Florida School of Banking and Finance and at the Institute of Law Studies of the Polish Academy of Sciences, and Dr. Nikolas Vagdoutis, who has been a postdoctoral fellow at the University of Luxembourg. Normally, we would also be joined by Dr. Anne Chadwick, who's my partner in crime, so to say, in this webinar series, but unfortunately, she got sick today and cannot make it. So I'll do my best to also fill in her shoes in terms of monitoring and kicking us off. So hi, Jens.
Hi.
And so yeah, I would just kick us off with a general question as an introduction, which perhaps will allow us to place your work also with regards to legal scholarship. So you talk about, so it's a bit of a question that has to do with terms. So you talk about economics and political economy and critical microfinance. So I was wondering if you could provide us with a conceptual mapping of these terms that you employ throughout your work. How should we understand them, and how do they feature in the context of your, broadly speaking, post-Keynesian background? Also, what is post-Keynesianism? There you go.
Okay, a lot of questions. Yeah, thanks. So I guess as a background, I came to these topics from philosophy. I was writing a PhD on the financial system and distributive justice. And then I became increasingly interested in how the financial system works on a more micro level, specifically also how the governance of financial markets work, monetary policy, banking supervisions, these very, very nitty-gritty topics. And then Dirk Bezemer, a broadly post-Keynesian economist at the University of Groningen, he was willing to supervise a PhD project in which I looked in a lot of detail at the European Central Bank, specifically its financial market operations, how these were structured, how they evolved. I guess from this perspective, I became what is often described with the nebulous term political economist, using the methodologies of political science, interviews, archives, data analysis, all these specific social science methods to understand economic institutions, specifically to understand the ways in which financial governance has evolved from the 1970s onwards, the specific ideas about legitimacy and the specific economic ideas that inform that. And on that basis, I'm now sort of I'm at the political science department. I'm broadly a political economist. Now, critical macro finance, a label, I think Daniela Gabor really gave the authoritative statement of what we mean by that term, is about balance sheets. So looking at capitalist economies in terms of balance sheets, the ways in which balance sheets also structure relationships of power, the ways in which they affect these interests that you're really interested in as a political economist, the distribution of power, the way in which capitalist economies evolve, the way in which the governance of capitalism evolves. And that specific perspective, I think, fits very well with the topics that I'm interested in, to really think about, okay, if you're doing these kinds of monetary policy operations, if you're doing this kinds of banking regulation, what kind of financial structures are you favoring? Which financial institutions benefit from that? What is the broader consequences of those choices for economic policy, for economic development? And there, I think you're really also asking the fundamental questions of economics, right? I guess there you have a very old set of disciplinary divides, 19th century marginalism, people like Karl Menger and Alfred Marshall, who start saying, look, there's this very narrow notion of economics that's about explaining prices, taking property relationships, taking institutional structures as given, and then really focusing on needs, on scarce resources, and explaining prices, but also a much broader notion of economics where you also are interested in the sort of institutions that make market transactions possible, property relationships that codify who can sell what at what point. And that broader notion of economics sort of gets you to political economy pretty quickly, right? So once you're thinking, okay, I'm no longer just trying to explain individual market transactions, I'm looking at institutions, then very quickly you're also interested in the politics of these topics. Okay, so that as a first, does this give you a sort of a lay of the land where at least I am disciplinary?
No, that's great. Yes, thanks, Jens. I thought maybe since you introduced this element of history of economic thought, talking about marginalism and so on, I was wondering if you could also say a word about post-Keynesianism as a school of thought and a tradition in which maybe you identify your work.
Yes. Yeah, no, that's certainly a tradition that also really influenced my thinking. I guess the way I would formulate the main contribution I take from that is the emphasis on uncertainty. That if you take uncertainty seriously, then a lot of the more traditional explanations of how prices come about no longer really work, right? So if you think companies don't really know how much of an individual product they're going to sell, then the marginal theory of prices just doesn't really help much in determining how much any individual product should cost. Similarly, I think if you take uncertainty seriously, then a lot of what happens in financial markets is about navigating the fact that we do not know the future, right? It's not an all-knowing investor that allocates based on a knowledge of the future where the profits are going to be made, but rather people in an office just trying to make the end of the day based on very imperfect information, and again needing a lot of institutional structures to be able to make investments. Yeah, so that's a bit of a more vague answer, but I guess the link between political economy and post-Keynesianism is that post-Keynesianism is really in some ways economics, right? It's really concerned about explaining prices, but that once you start taking uncertainty seriously, you start looking at agents setting prices in the context of constrained rationality, then very quickly you also get to institutions. But it's certainly not obviously a part of political economy. It's in that sense, just to the extent that it's interested in explaining these macroeconomic variables, it's really an alternative set of economic ideas.
So before passing the ball to Agnieszka, who I know has a question to follow up, I was wondering how that variable of uncertainty may introduce or not the factor of, well, public institutions and public power within price setting dynamics. And I'm asking this, I mean, I know it's a big question, but perhaps you have a brief, let's say, or the sketch, the outline of an answer, because this is a topic that links well to the previous webinar we had with Jamil Mudud, who stressed how much, well, in his perspective, prices are engineered and the role public institutions or the corporation play in determining prices. And actually, that's a pattern of thinking in law and political economy scholarship, where a number of different of legal scholars, for example, from the realist tradition, highlight how prices may be described as legally engineered. So I was wondering how the factor of uncertainty relates to that in your perspective. So if there might be this kind of link between post-Keynesianism and more institutionalist analysis or legal realism from a legal perspective.
Yeah, no, I think that's definitely true. So if you have a very optimistic understanding of the sort of knowledge that investors have and their ability to accurately price future revenues, then a lot of economic coordination can happen without the state, right? So then the role of the state can be limited to providing market infrastructure, and there are, of course, then also institutional conditions for investment. But I guess when you are more skeptical, when you think that doesn't work, and of course that's always a question, it depends on context, then suddenly you might also think there's more of a role for public institutions to provide information. And in fact, a lot of the work that Agnieszka and I have been working on in relation to climate and banking regulation is exactly about this, right? Okay, we do not know what the climate transition will look like. That means you need to make a regulation that provides guidance to investors, to banks. You also need to make regulation that allows banking supervisors, for example, to make choices on this, right? If you do not know whether a specific fossil fuel investment is going to return money, then first investors cannot price it, banking supervisors cannot properly supervise those investments of a bank. And there you then very quickly also get a role for public policy.
Right. Okay, thank you. Agnieszka?
Thank you very much. It's great to be part of this conversation. I would have, Jens, a little bit of a, I would say, a basic question about how you see law. And I think this is in this kind of interdisciplinary context between lawyers and law and political economy. Sometimes, you know, we forget that these views can be quite different about what law is and what law does. And you work a lot with lawyers, right? So a lot of your work deals with how we transform the roles and actions of EU institutions by reframing, rediscovering secondary mandates without really changing one word of legal text. So I guess I would be curious if you could articulate for us how you see the role of law in the research projects that you have currently going on. And I would be specifically interested in examples that you could maybe share with us about law's flexibility, law's lack of flexibility in other cases. And thirdly, maybe some examples, and I have one specific in mind that I hope you can share with us, of when the currently prevailing legal interpretation of legal provision seems to be completely at odds with what the legal drafters had in mind. And what are, from your point of view, the implications of this? Thanks.
Yeah, thank you. Yeah, no, I guess maybe to continue on this story of how I ended up where I am, right? So then doing political economy, looking at European Central Bank specifically, I came across all these anomalies, right? So there's this story you would find in a lot of documents where the mandate of the European Central Bank, for example, was meant to be very strict, right? And very narrow. And it was meant to bind that institution to a very narrow set of market operations, very narrow set of objectives. But then if you look into the legal text, there's very little there, right? It fits on 2 pages, basically. And then at that point, also at some point, I felt, okay, I'm gonna need help on this aspect, right? What is going on here? And then with Nick de Boer, when in May 2020, the Karlsruhe ruling came out on the ECB's big asset purchase program, we started writing on the specific gaps in the ECB mandate that we felt were at the core of this legal dispute. So I guess that dispute, the question, is the ECB allowed to buy government debt? And if so, under what conditions? There's very little in the actual mandate that says anything about this, but there's one very weird provision, the so-called prohibition of monetary financing, that says something like the ECB is not allowed to give direct overdraft to governments, and it's not allowed to purchase debt directly from them. But that formulation clearly leaves space for all sorts of other transactions that from an economic perspective are absolutely identical, right? It doesn't matter whether you buy the debt in the market or whether you wait for the treasury to sell that debt to a bank and then buy it, and as we now know, in some cases, a few days later. Okay, so that was an anomaly, and there we say something like there are authorization gaps in the ECB mandate. There are choices that the ECB faces, for example, whether to buy government debt or not, that just aren't covered in the mandate in any way. It's clearly allowed for the ECB to buy that debt. It's also allowed to not buy that debt. And under what conditions it does or does not do that, the legal text just doesn't really tell you much about that. And then that, I think, points to a much more general phenomenon that, for example, also Katharina Pistor has articulated in the legal theory of finance, that there's a lot of discretion and vagueness at the heart of financial regulation. Things evolve very quickly. There's not a set of ex ante rules that will be suitable for all circumstances. And this means that rather than codifying the core choices of financial policy, there are these very general provisions that allow unelected officials to make quite far-reaching discretionary choices. Now, it's a further question what to make of that. But what I hear from my friends who are lawyers, Agnieszka, also from you, is that there's something anomalous about this, right? I'm not really in a position to judge that, because this is the law I know. But there is certainly a very big discrepancy between how we sometimes hear that this law is supposed to work, giving unelected officials very strict instructions, and what we see in reality, where actually the law does not in any meaningful way prescribe a specific course of action.
Thank you, Jens. So I was wondering if one of our dear experts on the ECB wanted to follow up on this. I think this gives plenty of room for discussion. Maybe Marco, you want to take it from here?
Yes. So, Jens, you have written a lot on not only on the political economy of central banks, but also on, I would say, the constitutional role of central banks. And I would take it from there, given that we have a strong interest in all things law-related. How would you formalize the transformation of the constitutional function of central banks after the crisis of 2008? Is there something peculiar in that transformation concerning the European Central Bank? Or would you say that there has been a transformation that somehow concerned, I would say, at least all Western capitalist central banks? And I have also a follow-up question to that, because I think it is somehow related to the normative side of your work. It's kind of a more the political, philosophical aspect of your work. My reading of your work is that you would favor, as a way to address and somehow tackle questions of legitimacy concerning that transformation that I was just mentioning, you would favor not much the sheer abolition of the delegation of monetary policies, but rather some form of democratic or political mandate that basically is instantiated by the idea of delegating monetary policies, perhaps I guess, with certain instructions coming attached to it. So I wanted to ask you also if you could elaborate on this normative proposal. What is the content and the substance of this delegation?
Yeah, thank you. Yeah, and I agree that those topics are related, also in my mind at least. So let's see. So on the first point, I guess, so to start off from where we were just now, there's this very specific structure of the governance of finance with these unelected actors who have very high levels of discretion. And there are a number of functional reasons why that is the case. Fast evolving institutions, very sensitive to expectations, also sensitive to abuse, many historical examples where that power was not exercised in the right way, and where you need this combination of a quite high level of technical expertise and reliable decision making that in some ways favors something like delegated agencies at arm's length from elected government. Now let's bracket whether there are maybe entirely different ways of governing that would also work, but at least broadly for the sort of institutional structures we have with parliaments and executives having the roles that they have, there seem to be good reasons for making this choice. And then I guess this question of uniqueness, I would come down very much on the side of this being a much more general phenomenon than just the European Central Bank. I think it's also a more general phenomenon than just after 2008. I think we tend to start our story in the early 90s and then assume that there was a sort of democratic decision that created an independent central bank that was focused on price stability and that had interventions in money markets as the instrument to achieve that. I think if you zoom out, and this is what I'm currently trying to describe in a book that starts in the 1970s, in the 1970s, none of these ideas were widely accepted. There weren't really any central banks doing this because of the existing exchange rate arrangements. And then I think you see a process where central bankers also then start rethinking their role. So I think inherent in the sort of governance role that they have with these large amounts of discretion, there is also a tendency for quite substantive changes to be enacted by this political community. And this is what I've described as a process of paradigm shifts. I think both in the 70s, I think it's relatively uncontroversial that compared to earlier economic policy, that is a paradigm shift. And I think also after 2008, we have seen such a development. And I think it's the nature of monetary and financial policy that those changes aren't initiated by legislatures drafting laws. And actually all the attempts by legislatures to draft these kinds of laws in the 70s failed, right? The Bundesbank, there was an attempt to change the mandate that didn't go anywhere because of the Bundesbank organizing resistance to that. There's also changes to the mandate of the Fed in the 70s. Well, they just ignored most of those changes. So in that sense, I think what we've seen after 2008 is very much continuous with that longer history of central bankers looking at what the broader developments of economic policy are, also having views on that, right? I think it's pretty clear that the central banking community in the 70s and the 80s favored a policy geared towards price stability, towards a more prominent role of the market, private investment as a way of navigating the industrial crisis at that time, but also didn't do that in complete isolation from democratic politics. And I think across advanced Western economies, central bankers make very similar moves, despite, you know, you have a Mitterrand government in France and you have a Thatcher government in the UK, obviously not identical governments. So there is an element of the nature of these political systems allowing for a high degree of change initiated by unelected actors. And then that, I guess, brings up the normative question, is that a bad thing, right? Is this, and I think there's certainly a number of views you can take on that. Maybe I'm not even entirely decided on that. In recent work, also again, working with Agnieszka, also in a recent article with Serena Grunewald on the European Parliament's accountability role for the ECB, we have looked at coordination as a way of navigating the current challenges of central banks. So I don't think it's desirable for this, the ongoing paradigm shift, if we can call it that, to happen entirely inside the central banking community. I also think it would be bad to immediately end central bank independence and give all these choices to a political body, or expect parliaments to draft completely new mandates. I think in the historical cases where that has happened, who is going to think of what that mandate looks like? Well, obviously, central bank again has the expertise to decide that. But coordination, I think, makes a lot of sense. So if you now look at the European Central Bank, I think there's a number of these authorization gaps. So choices where the law just really doesn't tell the ECB what to do. That is, for example, the case still for the unresolved issue of how to deal with government debt by the member states. I think that's the case for how to deal with the catastrophic misallocation of capital in light of the Paris Agreement that we still see on a day-to-day basis. I think that's true for any project for a digital euro. I think that is also something that has at most the vaguest basis in the ECB mandate, and where I think it wouldn't be appropriate for the ECB to decide that by itself. And I think as a fourth point, there's also still the project of the international use of the euro, where I think, again, there are choices to be made. If you want an international currency, what does that international role look like? And I think the best way to do that is through some forms of coordination, where you both really rely on the expertise of the ECB itself, but also bring in a broader basis of democratic legitimacy.
Thank you, Jens. Unless Marco has a follow-up directly. So then I think, well, the topic of coordination actually brings up a question that I know Nikolas wanted to ask. So Nikolas, do you want to maybe follow up?
Yes, thanks for the invitation, Ioannis. It's very nice to be part of this discussion. Now, asking about this, the interinstitutional coordination that Jens suggests in various papers from what I've seen. So I have understood that this interinstitutional coordination is between the ECB and the EU's political institutions, right? To democratize monetary policy in the Eurozone. So Jens, do you consider this interinstitutional coordination possible under the current EU primary law framework, with the ECB enjoying a high degree of independence, given the content of Article 130 TFEU? So that is the first question related to the to your suggestion for the interinstitutional coordination. The second related question is, how would this proposal address the democratic legitimacy concerns over the ECB's contemporary much more political role that you mentioned in your work?
Yeah, thanks, Nikolas. Yeah, look, I don't want to be lawyer-splaining all of you, right? So let me just give you the line that I think really I'm very indebted to my co-authors on this, which is that no, the Article 113 doesn't preclude coordination. And I think the most basic argument for that is that if you look at the treaty, there are many provisions that suggest interactions between the political institutions of the EU and the central bank. And it would be really weird to have those provisions if coordination of some kind wouldn't be possible. So what Article 130 prohibits are instructions, right? So anything that involves binding instructions on what the ECB should do. But importantly, from the 2004 Olaf case against the ECB, we also know that that should be interpreted specifically in relation to the monetary policy task, right? So then at the time, the ECB argued that because of Article 130, no acts of EU law could be binding on it. And then I think the court ruled very clearly that would create a institution entirely outside the law, and that in principle just EU law also can apply to the ECB in various forms. Now, the question then becomes something of finding ways of coordinating that are in between, on the one hand, binding instructions that would hinder the ECB from pursuing its monetary policy task, right? So that would really interfere with its ability to set policy independently for the reasons that that article was introduced. On the other hand, finding ways of coordination that are meaningful. The treaty contains a number of provisions for accountability, but most for coordination are very much about people attending meetings. There's no direct forum for that. The core provision, to my mind, is the secondary mandate. The secondary mandate requires the ECB to support the broader economic policies of the EU. And I think it fits very nicely with the Olaf ruling in this regard, that once you say, okay, there's this specific monetary policy task where the ECB has a high level of independence, then we can also think about certain other aspects of its policy that have these broader implications that are about economic policy, where actually it does make sense for the ECB to rely much more on what other economic policymakers are saying. So if you look at the specific issue of climate change, would be very undesirable if there would be some kind of instructions from the political bodies of the EU that would require the ECB to finance a whole set of specific climate projects, because that might interfere with the pursuit of the primary mandate. But now, if you look at the choices it makes, when it has decided to pursue monetary policy objective, right, fighting inflation or deflation, it can do that with many different instruments, right? We've seen in 2015 that the ECB, in its corporate sector purchase program, bought a lot of debt from fossil fuel companies. More recently, we've seen the ECB also trying to shift away from that and also introducing measures that support the climate transition. Now, I think in making that sort of choices, right, where there are different ways in which you can pursue a monetary policy objectives, where some of them fit better with the existing economic policies, and where there are choices that economic policy makers also have the relevant expertise for, their coordination, I think, could really contribute to policy making. On the one hand, just making better policy, right? The ECB is not a climate policy maker. So the choice of what sort of policies to make shouldn't naturally rest with the ECB to begin with, but then also from a perspective of legitimacy. These are very far-reaching choices. What sort of energy sources we might be relying on the coming decades. I don't think it should be for the ECB to decide, for example, to what extent we rely on nuclear power. But that is something you could rely on coordination, and where it would be possible for the ECB in various forms of interaction with existing economic policy, also with policymakers at the political bodies of the EU, to set out a specific way of doing monetary policy.
Thank you, Jens. Agnieszka, did you maybe want to conclude the section on the ECB?
Absolutely. Yes, indeed. Couldn't agree more with Jens there, that there is something happening on this green monetary coordination space that is really promising. And maybe here the EU, and I think this is something that we'll come back to later, EU is quite particular in terms of a jurisdiction that is trying out this green currency transition. I wanted to go to a specific aspect of this coordination, namely international role of the euro, which is another very interesting paper that you have recently produced, pointing specifically to the kind of counter actions of the ECB, counterproductive actions of the ECB when it comes to promoting the international role of the euro. And I wondered if you could elaborate a little bit on how this could be changed. So how the ECB could be playing a more proactive role with regards to the promotion of the euro internationally, and if there is a green aspect to it. And here I am thinking also specifically about something that you do not cover in that paper, but I think could be potentially promising, namely the significant issuance of EU sovereign debt denominated or called green, right? So the green bonds under the Next Generation EU.
Yeah, interesting. Okay, maybe to take a step back. So yeah, this is a recent chapter. This is a project I'm now also working on with Stefan Murau, who also is very much like a international money markets scholar, where we want to think a bit more about internationalization of currencies. How does that work? And what would the ECB, what would the EU rather need to do to give the euro a more prominent international role? If you look into that, I was actually quite surprised. The actual use of the euro internationally just isn't clearly bigger than the D-mark, right? So if you look at, for example, the use in foreign exchange transactions, it's very similar. The percentage of transactions are now in euros as were in D-mark in the 90s. If you look at reserve assets, if you combine the D-mark, the French franc, the guilder, you get very similar numbers to the euro. So in that sense, the original ambition, right, we're going to create a European currency and it's going to maybe take something of the role that the dollar currently has, just none of that happened. And I think that reflects, as I argue in this chapter, again, these authorization gaps, right? That there is very little about how this international currency should work in the ECB mandate. And then a choice on the side of the ECB from 1998 onwards to say, look, the international role of the euro, that's economic policy, that's not really monetary policy. We're going to pursue price stability. We're going to make this a good, reliable currency. And then it's for the market to decide whether to use that currency or not. I think this is a huge missed opportunity. I think it's also pretty hard to defend from a perspective of price stability. If you look at last year, the inflation we had, energy prices, oil prices, natural gas prices, of course, the heart of the story, all these prices were denominated in dollars. So when the dollar certainly started appreciating against the euro over the course of this year, that directly exacerbated the inflation crisis in Europe. So there are, I think, really good reasons to take euro internationalization more seriously. And I think the way to do that, again, will require coordination. Right? So there's no instruction in the ECB mandate how to set up an international currency. We don't have a developed strategy for how to do that. And I think if we just rely on the monetary policy objectives, we might get an international, for example, a digital euro that has an important role within the European payment system. But I think in many of these developments, you need to make choices that have much more far-reaching economic policy implications. And then, Agnieszka, as you also already touched on, I think it's really interesting to think about the ways in which an international euro could be the currency of clean energy. So there's historically a very strong link between currencies and energy sources. So the pound is very strongly related to the development of British capitalism and the use of coal. More clearly, even with the dollar just emerges as this currency of oil, and its prominent role in the global financial system is almost inseparable from its role as the currency for fossil fuels. And I think in the same way, you could think of ways in which the euro could be the funding currency for large parts of the clean energy infrastructure. There's at the moment just so much investment that needs to happen that we also know will be profitable in the long run, that will just make economies more robust, less vulnerable, less dependent on importing oil. Why not see the euro in that role? And then what you said, thinking about the issuance of green sovereign debt, I think that could certainly be part of this package. Could also think about non-euro member states issuing these kinds of debts. I guess that's currently one of the really big blocks for achieving the objectives of the Paris Agreement, that a lot of states really find it difficult to borrow the types of funds they need to fund clean energy investments. Maybe it doesn't all need to be the dollar or the dollar in the skies of the IMF.
Thank you, Jens. Well, it's clear legal scholars read your work, and I know that one paper in particular that was read and discussed quite a bit was the one on technocratic Keynesianism, paradigm shift without legislative change. And I'm actually happy that we have Nikolas with us, because last summer we had a chance to discuss it together in the context of a conference. So I think that allows us also to continue the discussion on the ECB on a different register. So Nikolas, do you want to kick us off on technocratic Keynesianism?
Yeah, thanks, Ioannis. Yeah, it's a very interesting paper. So Jens, can you elaborate as to what you understand by technocratic Keynesianism? What does this concept mean specifically? And I have noticed also that in your work you use also the term moderate interventionism. Are these terms used interchangeably or in a different way? And then I will ask a second question that is related, I think. Yeah.
Yeah, thank you. Yes, so technocratic Keynesianism, it's a bit of a provocation, though in some ways the whole article is, of course, and it comes from a moment in 2019, 2020 that I still saw once in a while people saying, look, the ECB, it's a neoliberal institution, there's only one objective, price stability, and where I thought, no, actually, there's a lot changing. There's a lot changing. And one way to bring that out, I thought, was to show that the instruments that are being used are in some ways continuous with what central banking looked like before neoliberalism, before the specific monetarist conception of central banking emerged. On the one hand, monetary financing. I tried to show that a lot of the 2020 support for government bond markets really looks a lot like monetary financing. Again, here you see the critical macro finance, right? Looking at the balance sheets, looking at how these evolve, showing that they match very closely what is happening on the side of the treasury. And on the other hand, in the context of climate change, a return to credit guidance. So central bankers, banking supervisors also having an eye to the allocation of credit in the economy. So there's, on the one hand, a return to some of these Keynesian, if you would like to say so, but at least Keynesian era instruments, but in this case, very much under the authority of technocratic agents who over the course of the 80s and 90s have been placed in arm's length of democratic government. So there there in this term, these two developments come together to say something like, okay, before this we had something, maybe you call this market liberal technocracy, but this is technocracy with Keynesian instruments.
Can I follow up? Okay, but then my question is, do you consider that this is still the case, this paradigm, or now with the monetary tightening of the ECB, or there has been a return to the previous paradigm, to what you call market liberal paradigm, at least to an extent? And a second question is if you consider the EU primary law framework as tilting towards one certain paradigm for monetary policy. Because you have also this term of strategic ambiguity that you use a lot, and you can also develop it here.
Yeah. So I think this is all about strategic ambiguity. So I think around 2019, 2020, also before that, you could always find something, text where central bankers would say things that would allow you to say nothing has changed. No, there is no monetary financing. The objective of the public sector purchase program, of the pandemic emergency purchase program, is to pursue price stability, right? And people would sort of draw on these pieces of evidence to say nothing has really changed. And in the same way, if you looked at these practices of supporting allocation of capital in line with these climate objectives, you could always say, no, it is only about financial stability. It's about preventing excessive risk-taking, so nothing has changed. The term strategic ambiguity, this is really political science, right? Political economy is meant to show that, yes, people say these things, but sometimes in the same document, in other contexts, they also say very different things, right? So there are also places where people are very explicit. No, we're doing the pandemic emergency purchase program to support governments borrowing. Also, in all these climate documents, you can always find, no, we're doing this to support the Paris Agreement. So there's a moving back and forth, she also said, between an old paradigm that is sort of the spirit of a lot of the legal texts, and then also a new set of ideas, a new set of priorities. Now, of course, then in 2022, central bankers raised interest rates, and everybody was like, you see, there is no paradigm change. This is, again, the central bank moving back to the neoliberal paradigm. There was no change after all. Now, let's first just say, I think the question is very much still open. The debate around the climate impact of monetary policy started in 2016, and it was in the end of 2020 that board members of the ECB for the first time started talking about monetary policy and climate. So given that we're now 18 months out from the start of higher interest rates, I guess we're already seeing a lot of progress. So we've seen board members addressing impact of raising interest rates, for example, on clean energy investments. We also see that this time raising interest rates goes together immediately with the transmission protection instrument, which is meant to safeguard stability of bond markets. But there's certainly a return to a more traditional rhetoric. There's more of this traditional rhetoric than there was in 2020. So my thinking would be this takes a while to develop, but I think we'll also develop ideas about how to raise interest rates that will look very different from how central bankers talked about this in the 1990s and the early 2000s.
Can I step in? Because I think I have a follow-up question actually to this, which is partially related, Jens, to your work on market neutrality. I see that you put a lot of emphasis in your answer to Nikolas about the kind of attempt to change a certain type of paradigm of monetary thinking, I would say, because of the push coming from, or the pressure coming from issues concerning climate change, right? I mean, I'm intrigued here to basically probably ask to the sociologist, that might be you, what are really the forces, no, that have pushed ECB central bankers to interiorize, no, internalize the pressure coming from, functional pressure coming from climate change, or do you ascribe this potential change to a change in the composition of the ECB, like a new generation of political economists that have been socialized in a different climate, indeed, sorry for the pun. But what is intriguing to me is that in a couple of articles on market neutrality, you seem to really put a lot of responsibility, upon the shoulders of the concept of market neutrality, meaning that I would say the pre-2020 kind of dominant conception, that is, we operate according to the unstated principle of market neutrality, bears a lot of responsibility for several of the allegedly mistaken decisions taken by the ECB. Especially at a certain point, you seem to actually establish a causal link between market neutrality and the government debt crisis. So I wanted to ask you to elaborate a bit on these 2 points.
Yeah. Maybe I'll just focus on the government debt point, because that's, I think, has the right long time horizon to really see how these things have evolved and how the ECB has responded to them. Climate change is, of course, itself very new. So you might also always say, okay, it's just now something that's completely different. So in the early 90s, there was this idea, I think very widely shared between central bankers, that providing support as a central bank for government debt markets could contribute to overspending by governments. That was widely seen to be a major problem of European economies at the time. Big welfare states, industrial transitions that were ongoing, resulting in higher unemployment and social security, and then debt resulting from that, these sorts of topics. Then the choice was made to introduce this prohibition of monetary financing, but already at the time, people had a lot of experience with how unreliable government debt markets could be. And even if you look at an institution like the Bundesbank, for example, in 1975, they were forced to buy government debt from the markets to stabilize markets, right? So everybody had those experiences, and I think it's for that reason that these provisions were drafted the way they were, allowing for certain kinds of interventions in destabilized markets. And in that sense, I think what is often seen as something completely new, the security market purchases from 2009 and 2010, when the ECB started purchasing Irish and Greek debt initially, and then later also Portuguese and Italian and Spanish debt, that was really foreseen exactly in how this provision was drafted. Okay, so then why do we get this period in the late 90s and the early 2000s when central bankers take on a much more radical position, right? Where the idea is, okay, the central bank has no role in debt markets to begin with. And this is a development you see across advanced economies. So with yet another lawyer colleague, Will Bateman, we look at this issue comparatively also at the Bank of England and the Fed. And what's striking in that comparison is just how extreme the formulations are that the ECB uses to say we have no role for government debt markets. And there, I think you get to this topic of an authorization gap. So in the way the treaty is drafted, on the one hand, this exemption has been made that the central bank can intervene in the bond markets, but on the other hand, how and how much and by whom and under what conditions? None of this is in the treaty. And then already before 2008, the ECB starts getting questions about this. So in an article that came out last year, the ECB's treatment of government debt, I use a lot of archival sources, but also interviews with people at the time to focus on a debate going on in 2005, where a number of financial market participants are saying the ECB is supporting governments by accepting the government debt as collateral, and it doesn't even have strict rules. It will just always support the collateral from all these member states. It will always accept that as debt. And this is a very political choice, and they're secretly supporting governments. Now, and I think there, this psychology of neutrality comes in a bit, where the ECB feels like, but that is not our role. And now we are getting criticized for this. This, of course, against the background of the Stability and Growth Pact that isn't really working. And then the ECB, Trichet, comes out with this statement at a press conference. We are going to look very closely at credit rating agencies to determine which debt is eligible as collateral for monetary policy operations with the euro system. So if it happens that a member state doesn't have sufficiently high credit rating, then we are no longer going to accept that debt as collateral. So this happens all before the Eurozone crisis, right? But it sets the ECB on a specific trajectory where this whole topic of sovereign debt markets becomes toxic and has been placed outside its task. And then in 2009, but already in 2008, you get this big banking crisis, which just blows a catastrophic hole in the balance sheet of every advanced economy, right? So double number deficits. And what happens immediately in the US, they start a QE program. And then the year after that, also Bank of England, they start a QE program. So they start buying the debt that is in the market. And the reason for that is something very specific with sovereign debt markets, that these are markets where you just issue a lot of debt and there isn't always demand to buy all the debt, right? You have pension funds, they might buy the debt, you have banks, but if you suddenly issue 4 or 5% of your GDP in new debt in 1 year in that market, nobody's going to buy it. And then in the US and the UK, immediately these QE programs helped to mop up those debts. And that simply didn't happen in Europe in the first 2 years, didn't happen in 2008. And then already towards the end of 2009, you get the security markets program, and the ECB starts buying debt of individual member states. The security markets program also isn't smaller than the Fed or the Bank of England QE. If you look at it on the level of individual member states, it's also in the article with Will Bateman, where we look at, again, balance sheets, right? Just the size of these kinds of flows. And from that point onwards, I think also this policy of strict neutrality with regard to government debt is again abandoned. So this strict attitude of neutrality that's really only a very short period, somewhere from the spring of 2005 until the middle of 2009, but pretty catastrophic in what it then did to this sort of implicit expectation that the central bank will back the debt of the member states.
You think, just one very short, brief follow-up. I don't know whether you have followed the strategy review by the ECB, where there is a lot of talk of market efficiency. And I want just to ask you whether you think that this might become somehow the new main or dominant principle that inspires unconventional, or what were once called unconventional monetary policies.
Yeah, I've also seen that. I guess market efficiency is an incredibly general term, right? So almost any allocation can be described as efficient, as relative to some set of objectives. And I guess this is maybe not strategic ambiguity itself, but very closely related to these sorts of rhetorical strategies where the ECB is on the one hand pursuing entirely new objectives, but also sort of trying to couch that in more traditional language, and in some ways really hiding the novelty of the things it's doing. I think that's not helpful. I think also in a time of social media, I don't think these things work. I think also this strategy of neutrality with government debt, I don't think it worked, right? I think nobody thought the ECB's policy towards Greece was a result of technical rules that, were somehow beyond its control. And I think it's better to just address those choices more explicitly, and then also find these modalities of coordination for making these choices. And the idea that a criterion of market efficiency can really provide the right guidance on how to do climate transition, I don't think that will work.
Jens, I'm aware of the time. I wanted to ask, do you think we have 10 more minutes or so to talk a little bit about the green transition as well?
Yeah, I have to run in 10 minutes, so that should work.
Okay, so perfect. Agnieszka, then do you want to start?
Yeah, I'll be quick, because I think a lot of the topics of green transition have already been weaved into the discussion. So I think a number: greening monetary policy, sustainable finance, guide how the transition also changes the kind of framework of guidance and planning, technocratic Keynesianism. All of these things really connect in Jens's work. But I think one thing that also definitely comes out from our discussion is the level of complexity of this topic in the European context, due to the particulars of the institutional legal framework, for example, and that is maybe not the case in all the jurisdictions, right? So especially recently, we have this juxtaposition between the highly complicated world of sustainable finance, leveraging the centrality of finance to accelerate the transition in the EU via 20 pieces of legislation, very long and argued frameworks, versus the US, where they have some tax credits, right? And I guess my question is, kind of, have you looked a little bit? I know you have, but could you tell us a little bit on the research that you've done, kind of comparing the greening transition in finance approaches between the US and Europe, and whether you see risks for this? Is it kind of also from a political economy perspective, does it just make sense that there are a lot of different approaches, or is it rather also a source of potential risks, arbitrage, and slowing down the transition in general?
Yeah, really good question. Yeah, I think first just take a step back. I think it's just so funny how this Inflation Reduction Act happened, right? So in Europe, you had this long process, the high-level expert group, and the taxonomy, and then all the things in banking regulation, supervision, and monetary policy that we've been writing on, and across these member states, different initiatives trying to harmonize. This is the emissions trading system. Well, look, as you've already said, right? Just this list of all these measures that are everything except tax and spend, right? Because the EU has a small budget. So what do you get? You get regulation, you get special funds, you get all these different ways of supporting the green transition, but not that. And then in what looked like a few weeks' time, of course, we know much longer, people were negotiating this, and basically there are these reconstructions that go back to the Obama era and the failure of cap and trade things that give you now the Inflation Reduction Act. But suddenly just the US does this super traditional thing, right? Okay, we're just going to throw a lot of money at these specific projects, and that's going to be our whole strategy now. So very open question whether how this is going to work. It might work, might not work. What we're doing in Europe, it might work, it might not work. That's unclear, but it's already very interesting to just note that the EU and the US are really on very different paths at this point in terms of the bigger macro financial structure of the green transition. Now, is that going to cause trouble? And I guess, Agnieszka, you and I, we've been talking about this off and on, and it's so difficult to say at the moment in some ways. Since 2008, financial markets between the US and Europe have already become much less integrated, right? So you had all these European, ridiculously leveraged large European banks that tried to be in some ways involved in US investment banking. Now, that all didn't work very well. And now already in some ways these financial systems are more separate. But it's interesting to see that this divergence is happening where for a long time, particularly at the Basel Committee, the justification for doing international coordination of supervision and regulation was exactly this, right? The idea that if you do not harmonize minimum standards on the international level, there will be arbitrage, banks will be moving around the regulation to create risks for themselves. There will be unfair competition between banks from one jurisdiction and another. And now we see what, for all intents and purposes, seems quite substantial divergence in regulation. One, banks don't seem to mind very much. Regulators don't seem to mind very much. And also, there's nothing that suggests that, for example, now that EU banks are much more bound in terms of their fossil fuel investments, that changes some things. So that there may be two interpretations. One would be, okay, actually all these measures aren't achieving that much to begin with. I tend to be more optimistic and think that yes, actually a lot is changing at the moment. And the other is something about the scope for international competition between different lenders just being a lot more limited than is assumed in some of the explanations for why you need global harmonization of finance. But again, this is quite early days, right? And maybe alongside this story that's very much about banks, there's also a story about non-bank financial intermediation that takes up an increasingly prominent role in these sorts of fields.
Many thanks, Jens. Maybe one concluding question, and this has been very insightful, a really fascinating webinar, so I'm really glad we did it. So you have followed a little bit the developments around law and political economy. We have also discussed about it briefly. So from your perspective, where do you see the potential contribution of a law and political economy approach?
Yeah, that's a good question. Well, I guess my own work shows that I have a deep belief in the importance of careful legal analysis for understanding financial markets, for understanding capitalism. That a lot of the action is in the law. I guess it's generally also a movement that starts from a very specific shared beliefs about the importance of property relationships, legal relationships underpinning market transaction and capitalism, very much like political economy. I see the US law and political economy movement also, frankly, just picking up things that the political scientists are failing to do in the US, right? So the study of finance from a political science perspective, not as important a topic, and then specifically also often focused on a set of relatively narrow questions that can be studied with a very specific set of quantitative methods, whereas these sort of more interpretative questions where for example, the law becomes very important. I see more of that happening in Europe already at political science departments. And for example, last year, we had Saula Omarova attending a conference, and we were talking about this, right? So like, this is my tribe of people, but it was a conference with political economists, right? So, and that's why I guess I'm also really happy with the work you all are doing. That also in Europe, on the one hand, we get a much more developed discussion about these things in law, hopefully also in the US in political science. And I think also historically, these are fields that have not always been separate things. I guess there is scope for doing something specifically in Europe that links law and political economy with political economy. But yeah, maybe we can discuss that at some point.
Thank you very much, Jens. Thank you for taking the time. This was really great. I learned a lot. Thanks also to Agnieszka, Marco, and Nikolas for joining us. Well, without you, obviously, this wouldn't have been possible. So I'm really grateful for that, and I hope the law and political economy crowd that is going to watch this later on will also appreciate this. So again, thank you very much, Jens.
Yeah, thanks for inviting me.
Thanks a lot. Bye.
Thanks
Bye.
a lot.
Thanks, bye.